will be chapter 10, that is the related to decision making, and we had done it earlier. The situations which requires decision making. Now we will go through it from the textbook. We will read the theory as well for the chapter, that is first is decision making. What is decision making actually? Managerial decision making involves 5 steps. Define the decision task. It may be called as what is the problem, because the decisions problems require some decisions to be taken. When we have defined the problem, define the decision task, identify the alternative courses of action, means that is corrective measures. Several corrective measures, that is the options generation. We may also call it as options generation. Then collect relevant information and evaluate each alternative. That is, we can see the advantages or disadvantages, pros and cons of each option that we have evaluated. Then it is the select the preferred course of action. Preferred means that is the best solution. They are also discussed in the meetings and all that things happen. Then the final decision is taken. Then analyze and assess decision made, means this relates to the final implementation. Done. So these are the 5 steps involved in the decision making. Now, further it is written here is that both managerial and financial accounting information play an important role in most management decisions. That is, managerial and financial accounting information is always important for management decisions. Not only managerial, not only financial, they can be used, they are used in conjunction with each other. The accounting system is expected to provide primarily financial information such as performance reports, budgets for decision making. Non-financial information is also relevant. However, it includes information on environmental effects, political sensitivities, and social responsibilities. We may call non-financial information, non-financial factors as intangible factors or pestle factors. Pestle factors. Political, economic, social, technological, and legal factors. Done right now, till now, any issues, problem?
No.
Okay. Now, relevant cost that we have discussed, that is only the relevant cost is the important for the decision making, but there are several relevant costs. We should go through it. Most financial measures of revenues and costs from accounting system are based on historical costs. That is, this is for financial accounting. Historical cost means the actual cost on which the asset was acquired. Like we saw it in case of, let's suppose, equipment. And how we write this? Equipment is cost 50,000 less accumulated depreciation. So whatever the amount is, we are not concerned with it. But this is known as historical cost. That is the cost of acquisition. Although historical costs are important and useful for many tasks, such as product pricing and the control and monitoring of business activities, we sometimes find that an analysis of relevant cost or avoidable cost is especially useful. In managerial decisions, only relevant cost or avoidable cost are useful, important. Three types of cost are important in this analysis. Number one is sunk cost. We know that what is the sunk cost? That is the past cost incurred. But there is certain another cost that is known as out of pocket cost. Out of pocket cost, we will discuss it in detail after a few minutes, but it is just related to the future outflows. In one word, we can say that out of pocket expenses are future outflows. And obviously the opportunity cost. And you understand the concept of opportunity cost. Now here it is sunk cost, out of pocket cost, opportunity cost. Sunk cost arises from a past decision and cannot be avoided or changed. It is irrelevant for future decision. Then out of pocket expenses requires a future outlay. That is the future outlay. Future outlay of cash and is relevant for current and future decision making. These costs are usually the direct result of management decision. For instance, future where it is future purchase of computer equipment involve out of pocket expenses. So the key is the future, that is related to the future outflows. And opportunity cost, you know it, that is the best alternative foregone, that is the opportunity cost. So we will not discuss it. Okay, this para is very important. Not only cost is important, some relevant benefits needs to be analyzed in the decision making. What is being said here is, besides relevant cost, management also consider the relevant benefits. Because the cost, this is the analysis of what? Cost versus benefits. It's always a combo of cost versus benefits. So besides relevant cost, management must also consider the relevant benefits associated with the decision. Now, what are the relevant benefits? So relevant benefits refer to the additional or incremental revenue that is we get from the any outside order or in the form of make or buy decisions. So additional incremental revenue generated by selecting a particular course of action over another. For instance, a student must decide the relevant benefits of taking one course over another. In some, both relevant cost and relevant benefits are crucial to the management decision making. So we have to remember that it is the additional or incremental revenue. Done? Any issues?
No.
Okay, now managerial decision scenarios. We have got several scenarios that we had discussed earlier in our last session, but we will now see it through the textbook. That is number one is managerial decision is additional business. Additional business means that is similar to accepting an offer, whether to accept an offer or not. This is known as accepting an offer, additional business. We will go through it example. Then we have another practice question that we will do it. So we have the complete understanding of this. Okay. Fast track is operating at its normal level of 80% of full capacity. Now the first sentence is giving you indication that the company has still how many percent of capacity?
20%.
Obviously. Means it can extend its operation as well. Right? It
Yes.
can produce extra things as well. Okay, at this level, it produces and sells approximately 100,000 units of product annually. Produces and sells means there is no ending inventory. Whatever is being produced has been sold. Its per unit and annual total costs are shown in Exhibit 10.2. This is Exhibit 10.2. The data that is sales of 100,000 units per unit is 10. Annual is 1 million. Direct material per unit. Direct material, direct labor, overhead, selling expenses, administrative expenses, total cost and expenses, all are given. This is the selling price. These are the total costs and expenses. So this minus this will be our operating income profit. And this is the total profit of the 10,000 units, 100,000 units. $1 will be 100,000. Now, what is the issue? Issue is that a current buyer of Fast Track's product wants to purchase additional unit of its product and export them to another country. So that is not the issue, whether he export or not. But the issue is that another buyer is a current buyer is wants additional units. This buyer, now the condition, now the situation starts here. This buyer offers to buy 10,000 units of the product at 8.5 per unit. Organization is currently selling that product at $10 per unit, and he has offered to buy at 8.5 means this is the sentence, or it means that it is 1.5 less than the current price. That makes sense. Then the offer price is also low, but Fast Track is considering the proposal because this sale would be several times larger than any single previous sale, and it would use idle capacity as well. Also, the units will be exported, so this new business will not affect current sales. So the situation is that whether to accept this offer or not. To determine whether to accept or reject this order, management needs to know whether accepting the offer will increase net income. Now, this is the solution part, but we will see it later. But the practice which we had followed earlier in this type of situation, I want you to solve this question and have your decision whether the offer should be accepted or not. Can you do it?
Sure, right now.
Yes. Life.
Hello?
Yes, yes. Start doing
Okay,
it.
right now. Okay,
Yes,
okay,
yes.
I'll yes.
Life practice. Done?
No.
Okay.
Sir, here, should I include overhead in the contribution, in the variable cost?
Yes, if nothing is, if nothing is given, then it is considered as variable.
Okay, and then selling and administrative expenses will not be
Obviously,
there
because they are incurred
in the
for
variable cost.
obviously, because although they are variable, but they are not relevant for this decision-making purpose. Are you getting this point? Because selling expenses and administrative expenses
Hello?
are, yes, hello. Although, hello, can you hear me?
I can hear you.
Okay, what I was saying that.
Yeah, I can now.
What I was saying that although selling and expenses or administrative expenses may be variable, may be fixed, but they are incurred for increasing the customer base. But here is their customer is definite and one, and he has uh, sent us an offer. So therefore, these costs will not be incurred for this customer. So they will not be relevant for our decision making. Are you getting this point?
Because here we have to do the contribution margin
Yes.
analysis, right?
Yes, yes.
This is not there. Got it.
So now what's your answer? Should this offer be accepted or not?
Yes, because the contribution margin is positive. So yes. And it's 17,000.
Okay. What you have done, you see the contribution margin, that is 8.5 minus 3.5 minus 2.2 and minus 1.1. What is the CM?
CM is 68. Oh no, CM is 17,000
Per unit, per unit.
per unit.
1.7?
Yes.
Okay. So since CM is positive, so it is evident that it should be accepted. Clear?
Yeah.
Now we will see it through another approach, what they have done. To determine whether they accept or reject this order, management needs to know whether accepting the offer will increase net income. Now we are not focusing on only the CM of that product or that offer. We are now focusing on whether it will increase our net income or not. Net income means that is the income from the existing product line, sale of the products, and also from the that offer that we have get. The analysis in exhibit 10.3 shows that if management, okay, this is the solution. Now this is per unit 8.5. Direct material is like this, that we have working of 1.7 of CM, and if it is continued from the selling expenses and administrative expenses, then we can see that from the additional units of 10,000 of the offer, we may have suffered loss of 5,000. Are you getting this working or not?
Yes.
What we have done here, or what it is being done here, that is all the costs are assumed to be associated with this additional units. Now, this is the current business. This is the additional business. The both will be summed total. And finally, we got what? Operating income of total of 120,000. And if that offer is not accepted, then we will get a revenue of total 100,000. Now it is very clear, or it is very wise decision to use the extra capacity and to earn the extra revenues. Now this analysis will clear the viewpoint. The analysis suggests that the additional business be accepted. Why accepted? It would provide 85,000 of additional revenue. That is 85,000 additional revenue, while incurring only 65,000 of added cost. Means your additional revenue is 85,000 and additional costs are 65,000. It means you are getting additional net income, and the combined net income will also be increased. So this would yield 20,000 of additional pre-tax income. That is, if there is a tax, it would be lesser, otherwise it will be not. So it would be additional pre-tax income. Or a pre-tax profit margin of 23.5%. If we calculate that margin, it will become 25,000. So the conclusion is that we will get additional income of 20,000. Therefore, this offer should be accepted. Clear? So we can.
Yes, but sir, how
Yes.
is the overhead 5,000? Why isn't it? Why isn't it 11,000? Sorry.
It is given in the questions, basically. We omitted this. Manufacturing of 10,000 additional units requires direct material of 3.5, labor 2.2, the same units, and manufacturing of 10,000 additional units adds 5,000 of incremental overheads.
So it adds.
So
then it would be 16,000, not 5,000.
Additional. We are just doing the accounting, or we are doing the analysis of what? Additional.
No. So we don't look at the 1.1 rate for the overhead.
Yes, definitely.
We look at the 5,000 that's given.
The additional that we are incurring. Okay, incremental commissions and selling expenses of 10,000 units would be 2,000, all variable cost. So they are here written as 5,000 and 2,000. And incremental administrative expenses of dollars would be, for clerical efforts are needed, all fixed costs with the sale of 10,000 units. So it is additional incremental is 1,000. So we have considered this. What we have learned here. incremental cost and benefits, additional or incremental revenues. So revenues or income would be what? Income would be revenues minus cost. And this is what? Additional or incremental analysis. Clear with this?
Yes, also, sir, why didn't they, okay, so when you're calculating the CM in this example, would you include the selling expenses? Because here it says all variable costs.
Yes, we have to calculate. We have to calculate this as well. So CM would be revised. And minimum we have to get is positive. So if we can revise our CM analysis, it would be like this.
Sales is 85,000.
Do it for per unit. It wouldn't have any
Oh,
effect. 8.5,
8.5. Material is 3.5. Labor is 2.20.
but wait,
Overhead is 5,000.
5,000 divided by 10,000 per unit would be
0.5.
0.5.
Yes.
Which overhead? Wait. Selling, admin.
No, overhead is 0.5,
Wait,
not
wait.
1.1.
This overhead is assumed to be variable 1.1. What here it is being said? Is it administrative? Okay, sorry. .5 and selling and admin are administrative expenses are fixed.
0.2.
Admin expenses are fixed, so they will not be in the CM calculation. Selling are variable, so they will be in the CM. 10,000, 2,000 divided by 10,000.
Yes.
Amount per unit. 2,000 divided by 10,000, 0.2.
Yes.
So CM
Is 2.1.
2.1. Also CM is, since in this case is also positive, so there is an indication that offer can be accepted.
Yes.
Done. So there are two ways: incremental revenues or CM basis. So we can make a summary of it as well. That is, accepting an offer can be done through CM basis.
So which one do you suggest that I do like first?
CM basis. But if questions restrict you for the incremental cost basis, then you have to do it as well. So you should know the both approaches.
So in the second method, I just have to do the whole, income statement analysis.
Yes.
Instead of just finding the CM, I have to find the operating income.
Yes.
And then add it to the current one.
Yes. You have to make 3 columns. Separate, current business, additional for the offer, and then combined.
Yes.
CM basis or incremental.
Also, sir, why is that in another table they said that for this offer, there was a $5,000 loss?
Where?
This above the table before this. Yeah, this one.
If we consider only that offer on that price, then we will be incurring loss. See, direct material, direct labor, overhead, selling expenses, administrative expenses, total cost, and operating losses.
Because here the CM was 17,000. That's why.
No, CM is at the rate of 2.1, but selling and admin expenses are
14,000.
14 and 8. 1.4
and then even the overhead is not 0.5. It's 1.1 here.
At the same rate. So this is, and this analysis is basically wrong. Why it is
We
being
shouldn't
written?
do it like this.
To make this decision, must analyze the cost of this new business in a different manner. Usually, accountants which do not know about the relevant cost or irrelevant cost or some variable aspects or additional information, then he may make like this. But after getting the relevant information, we should have write up like this. We should have calculated like this.
Yes, and this relevant information will be given in the
Obviously,
question.
obviously.
Okay.
Shall we move ahead?
Yes.
Now the second option, thing that requires decision making is make or buy, that we have done. But again, we have to do it with the textbook. The managerial decision to make or buy a component for one of its current product is commonplace and depends on incremental cost. Again, the textbook is working on the incremental cost. To illustrate, fast track has excess productive capacity. It can use to manufacture part 417, a component of the main product itself. Basically, what is being here, the scenario is might be that the product finished goods is product X, and it is used, and it is in its making one part 417 is being used. This part 417 the company used to buy from the outside. Now the company is considering to make this product in-house. Now, obviously, if they decided, if they are buying, so there will be one cost, that is purchase price. And if they decided to make, there will be several manufacturing costs. Are you getting this point?
Yes.
So we have to compare it, manufacturing cost, with the purchase price. And obviously, if we have to make, then manufacturing cost should be lesser than the purchase price. Then it will be worthwhile to set up
Making it
to
in-house.
making it in the organization in the in-house. Okay, let's continue. A component of the main product itself. The product is currently purchased and delivered to the plant at a cost of 1.2. So purchase price is what? $1.2 per unit. Okay, Fast Track estimates that making 417 would cost 0.45 for direct material. Now costs are coming. 0.5 for the direct labor and undetermined amount of for overhead. This creates a very, we may say, ambiguity. Undetermined amount of overhead. We don't know how much overhead will be incurred in making of this product. So we have got only two costs right now, 0.45 and 0.5. It will be 0.95, isn't it?
Yeah.
For manufacturing till now, without overhead, it will be 0.95. So apparently it looks attractive that we should make it. But let's see. The task is to determine how much overhead to add to these costs, so we can decide whether to make or buy part 417. If Fast Track's normal predetermined overhead application rate is 100% of direct labor cost. So what would be the overhead? This is direct material plus direct labor. And if we want to apply overhead, then it is of what? 100% of direct labor
Directly.
cost. So how much?
So it would be 0.5.
0.5. And now the total cost would be?
It would be 1.45.
1.45. Now we have arrived at the total cost. Now it would be worthwhile to produce, make it, or we should restore to buy it.
Buy it.
Okay. Now let's continue reading. We might be tempted to conclude that overhead cost is 0.5 per unit computed as 100% of 0.5 direct labor cost as we did in our calculation. We would then mistakenly conclude that the total cost is 1.45. This sentence is very important. We would then mistakenly conclude that cost is 1.5. And we have also
Yeah,
concluded this.
because
Yes.
is it because the overhead is applied? We don't know the actual overhead.
It may be, but there are some other reasons as well. Now, continue reading. A wrong decision in this case would be conclude that the company is better off buying the part at $1.2 each than making it for 1.45 each. Apparently, this decision is like that the company should buy it rather than making it. Okay. Instead, as we explained earlier, only incremental overheads costs are relevant in this situation. Thus, we must compute an incremental overhead rate. Incremental overhead cost might include, for example, additional power, machines, extra supplies, added cleanup cost, material handling and quality control. We can prepare per unit analysis in this case. Now, what is the important is that we should go for what? Incremental overhead rate.
Is
Are you
it the
get-
way we did in the previous
Yes,
question?
yes, because we cannot apply the 100% of the direct labor cost because that direct labor cost is applied for. Now, listen this point very carefully. That 100% direct, that labor cost is applied, or this 100% might be taken from the production of the finished product. And in finished product, labor cost or labor application might be greater. There are some other, you may say, intangible factors, that their proportion of the skilled labors may be higher in the production of the finished goods. But this is just a making of the one of the part. It may not require that much amount of skilled labors or that much amount of the required labor force. So applying 100% of direct labor cost would be not, we may say that not justify this to calculate the total cost. Are you getting this?
Yes.
Okay. Now this is just columnar analysis. That is, if we make that, then we have to incur 0.545 of material, 0.5 of labor, but overhead is unknown. So the total cost would be 0.95 plus unknown of overhead cost. And if we buy it, that is the simple direct cost is 1.2. Now we can see that if incremental overhead costs are less than 0.25, the total cost for making the component is less than the purchase price of 1.2. And fast track should make the part. Fast track's decision rule in this case is that any amount of overhead less than 0.25 per unit yields a total cost of 417. Okay. This is the analysis. This is the final say. Fast track must consider several non-financial factors in make or buy decision, including product quality, timeliness of delivery, reactions of the customers and suppliers, and other intangibles as employee morale and workload. However, these are things maybe must considered, but in this situation, what we conclude that is that there is a lack of sufficient data, because we haven't given any incremental